Samuel Pelaez joins us today. He is a CIO for Galileo Equity Advisors. Samuel, welcome. Thank you for coming here.
Thank you for having me once again.
First of all, let's talk about the GDP growth. In the second quarter, it came in at 4.1%. Is this sustainable in your eyes?
Well, firstly, it's a very impressive print. It does showcase some of the great things that the U.S. has been able to pass through in the last 6 months, specifically the corporate tax cuts. Mm-hmm. They're now in a more competitive level relative to the world. I do think this is not sustainable above that 4% level. I do think we can sustain a much higher rate than we've sustained for the past few years. I expect something more in the 3 to 4% range, which is still very, very healthy and should support most sectors and industries going forward.
Good to know, my friend. Thank you. What about tariffs? Are tariffs going to hinder any further growth?
Absolutely. And if anything, that's the big element that may challenge this 4%, 3 to 4% growth angle that I suspect we may sustain going forward. What's happened with tariffs is tariffs are a domino effect, mm-hmm. right? At first, it may seem that it benefits certain sectors. You're protecting some domestic production, even expanding domestic production because you protect the prices. Mm-hmm. But as you start moving forward, it starts affecting consumers. And we've only been talking about tariffs for a few months, but we've already seen big S&P 500 type corporations make very substantial announcements about the detriments of these tariffs on their bottom lines. So at the end of the day, the consumer ends up losing with tariffs. There is short-term benefits to certain industries, employees in certain sectors, certain communities in the States, especially Middle America, which is phenomenal. Right. But later on, this domino effect catches on, and the consumers in the U.S. end up paying for it and suffering on their pockets. You mentioned certain industries may benefit. Could you take us down some of those roads? There's a big misunderstanding about what the U.S. economy is really powered by. Mm-hmm. The U.S. economy is powered by agriculture and technology. And by technology, I mean the people who sit at Apple and design iPhones is more like a service-based economy. So it's agriculture and services. Mm-hmm. The manufacturing is actually big, but it's not as big as most people think. Mm. So that industry, the manufacturing industry, would benefit somehow, specifically certain industries like the local domestic producers of steel, because all of a sudden their steel product can be priced much higher because it's competing with higher prices for imported steel. But I saw this statistic which I found was very interesting. It said there's 330,000 steel workers in the U.S. who will benefit from this directly or indirectly, and their communities as well. Okay. But there's over 350 million Americans who consume steel products in their cars or in their homes or in civil works that they use and they pay for with their taxes. So at the end of the day, it's a ratio of about 1 to 100, or 1 to 1,000. So there's really not so much of a great benefit long-term and down the road, I believe.
Fascinating stuff, my friend. Jeffrey Curry, the head of commodities at Goldman Sachs, said the outlook for commodities at the end of the year is positive, and I think we need positives in this day and age. Do you agree?
Absolutely. The trade war, the trade talk, the news headlines that we've all been seeing have sort of like taken the foot off the gas a little bit. People are concerned. Sure. If you're building a multi-billion-dollar facility, you may just hold off, see how the tariffs are going to affect you before you commit. But my expectation is that this is just a negotiation tactic. Some things globally are going to change. The WTO is probably going to be repurposed or reinvented in some way. But an overall, out there, all-out trade war will be detrimental to everybody, the U.S. and China included. So I don't think anybody has a vested interest in that happening. So I think what Jeffrey Curry is trying to say, and I read through his report that came out 2 weeks ago, was there are certain sectors that look good right now. Some of them don't really look that great because of this trade war angle. But as we get some resolution and we go later, through the later part of the year, we may get to some points where there's agreements and resolutions, and then people can go back and step on the gas, sign off on these mega, projects, and then that demand pool will be there for most commodities. He's very positive on the base metals. And when I look at, when I hear these comments from people saying construction is at these all-time highs in many parts of the U.S. and Canada, mm-hmm. And actually, China as well, there's no slowdown there in terms of construction activity. Mm-hmm. it's a great time to be invested in commodities. And if you're not invested in commodities, it's a great time to start investing in commodities and take advantage of what could be, a decade-long cycle starting, anytime now.
Speaking of commodities, could you possibly give us a few names, some of your picks? Who have you got your eye on? And
Yeah, we generally are big advocates for the material sector as a whole, paper and forest, base metals, even uranium is very interesting right now. But I think we're specifically in Canada. It's a great time to talk about crude. The energy sector in Canada has been under enormous pressure for the last 3 years. I feel like many participants in the space are very frustrated. I call it peak bearishness.
Peak bearishness. Now, this is a term you've coined, hasn't it? Okay.
And when I go around and I talk to advisors and I talk to the companies and the executives, I feel this frustration because they've done everything in their power to turn the sector around, and they just haven't had any support from the federal government. And it's been 3 years in massive pain in Alberta, especially, and there's been issues with the pipelines and political issues.
Sure.
We're export constrained. The U.S. is increasing their own production, so they're willing to pay less for ours. But I think we've hit that point where the government feels like it's against the ropes. They've finally started to actually act on behalf of Canadians and the Canadian economy, and we saw the Trans Mountain deal that they arranged to essentially take control over it, to be able to pass legislation. So I think this is a time to start looking at the energy sector in Canada. When you look at it, it's actually not performed very well this year. It's up slightly, but not much. But crude has had a phenomenal year. The Canadian dollar has depreciated. Yeah. So net for Canadians, the differentials with the WCS differentials have stayed reasonably flat. So there's a big case for these companies to continue to do well. Two of our favorites are Yangara. Both of these companies, and the second one being Gear Energy. These two companies share the type of fundamentals that we like in any of our stocks, not just in the energy sector. They have high return on capital. They trade at slight discounts to their peers. They have decent production profiles going forward, and these are companies that we suspect will do fairly well going forward.
Good to know. Thank you so much, Samuel, for joining us today.
Thank you.